Welcome to the GSX podcast, where we explore the evolving landscape of commodities, trading, and alternative capital. Hosted by me, Henry Walsh, and our team at Great Southern Cross Commodities, the podcast brings together market participants, managers, and investors to discuss how capital, policy, and innovation are reshaping the global commodity markets. From carbon to coffee, energy to macro, we cover the full commodity investment universe, unpacking the trends, risks, and opportunities that matter. Please note, the views and opinions expressed on the GSX podcast are those of the hosts and guests and do not necessarily reflect the views of Great Southern Cross Commodities or its affiliates. This podcast is for informational purposes only and should not be considered as financial, investment, or trading advice. Listeners should conduct their own research or consult a professional advisor before making any financial decisions. Today on the GSX podcast, we're joined by my friend and former boss, Mark Allen, CEO of Thera Capital Management. Mark has more than 25 years experience across commodities, trading, and agricultural finance, including 15 years in global cotton trading from regional Australia through to markets in China and the United States. In this conversation, we talk about what physical commodity trading really teaches you about risk, trust, and performance, and why agriculture remains one of the most misunderstood asset classes when it comes to capital, insurance, and risk management. With that, here's my conversation with Mark Allen. Welcome to the GSX podcast. Today, I have with me Mark Allen, what's your official title, Mark? Managing Director of Thera?
It's good enough.
That's good enough. Mark and I go back a number of years professionally and personally. He's got a very, very interesting background, and without me giving too much away, has been in commodity markets for a number of years and is now based in Australia running a fund focused on funding the agricultural sector here in Australia. And I thought it would be very interesting to learn more about what his business is today, but also through his trading career, the lessons learnt over the years. Hopefully some wisdoms come out of commodity trading. I like to think there's a few nuggets we learnt along the way and how they apply to his business today and approach to business in general. So without too much more of an introduction, welcome, Mark.
Thanks, Henry, and congratulations on your new program of podcasting.
Thank you. As I said in the intro, I'd love to just, for the broader audience, if you can give a bit of a background, how you got into commodities, agriculture, and maybe the first sort of 10, 15 years of your commodity trading career.
Yeah, I grew up regionally in Australia, so grew up in Western New South Wales, a little town called Menindee near Broken Hills. So I grew up aspiring to be a farmer. That's all I wanted to be. As it turns out, there's no doubt about it, I never made it in farming, and so redirected my energies, still wanting to stay in agriculture or agribusiness. So I had an opportunity, as fortune would have it, to join a company called Collie Cotton up in Moree as a cotton classer, and that was really the genesis or the opening of the door for 15 years in the cotton trading business. But my background is agriculture, agribusiness, student of all things agri, and learning something new every day.
Yeah, that's for sure. And in terms of when I met you, you recently left econ and was starting the cotton business at Noble. But before getting to Noble, how was the path from, classing cotton for Collie in regional New South Wales to, you're based in Dallas and sort of traveling the world, buying and selling cotton? What was that transition like?
Yeah, one thing that one learns with your career is that it never looks like the spreadsheet, sort of when you set it up. And it's almost never a linear line. It's always a squiggly line. But I was also fortunate that I had some people in my career that sort of supported me, encouraged me, and also offered opportunities that were, in hindsight, pretty unique. So I started at Collie in Moree classing cotton, and I went to cotton school in Memphis, Tennessee back in, a long time ago, but that was in order to broaden my knowledge of cotton. So I'd always had an interest in cotton. I'd always thought it was a very progressive industry as far as ag goes. And as history would show, that view has been proven right, at least in Australia. And so I started in the classing room, classing cotton. I moved to a warehouse, looking at moving cotton around from A to B, exporting cotton, doing documents, letters of credit, and then had an opportunity to move to the Collie office in Sydney to help develop the China market in the early 90s. As a young kid, had plenty of ambition, plenty of energy, probably just enough knowledge to be dangerous, and packed my bags and off I went to China. I used to travel to China for minimum of 2 weeks, often 6 weeks, just travelling around. This was when China still was using steam trains for moving cargo. A lot of people had never seen a Westerner in real life. So it was a pretty interesting experience in terms of seeing China really moving out of where they were from the period, the Great Leap Forward and the Cultural Revolution to really becoming capitalists proper. So that was interesting. And then a couple of years of doing that. And then my boss at the time, who was the CEO of Collie, who in hindsight took not a small risk on me, said, look, would you be interested in packing your bags and heading off to the US to set up a US trading operation? And I was newly married at the time. Without surprise, I said yes, and off I went. Turned up in Dallas, Texas, with a couple of suitcases and a credit card, and set up an origination and trading operation for US cotton for Collie, and did that for a couple of years. Again, a very steep learning curve. By this stage, I was sort of late 20s, I suppose. And then while I was in Dallas, got to know the ecom guys pretty well, the Stevies, who are a wonderful family. And they offered me a role there in Dallas. Worked with them there for a few years and then moved back to Australia in, I think, about 2001-ish. And then moved up to Singapore in about 2006 with ecom. And then that was sort of the entree into Noble.
It's never linear, is it? I guess. So packing your bags and heading to the other part of the world to go to the next stage of your career and the next stage of life. And in terms of operating in developed markets versus developing markets, and it sounds like when you're in China was extremely on the developing side of that versus how China is today. How did that, as a kid from, as I said, from regional New South Wales, sort of seeing the pace of development, I mean, how has that sort of impacted your view and your sort of thinking about how countries develop and how markets develop, I guess?
Yeah, that's a pretty big question. I think one thing that one learns fairly early on in terms of international business is that not all cultures are the same, just to state the obvious. The trick is how does one coming from what is largely a monoculture adjust your business practices, communication style, everything about how you do business to suit local cultures? So you learn fairly on in the piece that the best approach to a new market or a new culture from a business perspective is to be cautious and curious. One thing you know for sure is that when you turn up at the international airport in Karachi or wherever it is, one thing you know for sure is that the local culture is not the same as where you've come from. So I think there's a lot of adjustment, and I think it helps to participate in local business culture rather than to try and reinvent it or to say this is how it should be done. Because as soon as you sort of get onto that trajectory, almost entirely the opportunities evaporate, people withdraw, and mistakes are made. So long answer to the question.
It's always a challenge when you're operating an international business because cultures are very different, customs are very different, and the approach has to be tailored for each. Getting into the sort of one vein of questioning in terms of, or line of interest, I guess, for me, in terms of one similarity for a lot of Australian, either current or former commodity traders, is coming back to Australia and finding a career either in trading or in something else. But I guess not generally about Australia, what have you learned from running trading businesses, being a trader, that you think has impacted the way you make decisions, operate your business that maybe not so in a different business sphere, I guess? Like what skills are useful? Some of them maybe not useful that you think, whether it's in Thera today or in other businesses that done since getting out of trading.
Yeah, I think on the Australia piece, almost without exception, expats come back to Australia and think I've just had 10 years overseas, broad experience, broad relationships, and they come back to Australia and they think I'm going to fit right in here, I'm going to add value and I'm going to show the locals how it's done. Every time that becomes a disappointment because Australia has a very well-worn path of how we like to do business. We've got a pretty established tradition of the importance of local relationships. And so a lot of that experience that one develops offshore and those networks offshore are of limited value locally. And so I think it's careful. One needs to be careful that as an expat coming back, your expectations are probably set more of a local level rather than too high a level because you'll disappoint yourself. In terms of international business or trading and how that is modelled, at least the way I think about business these days, I think it certainly has widened my ability to put things in context. You don't get surprised by too much these days. Maybe that's age, maybe that's travel, could be both. I think also one thing that I probably underappreciated in my trading days, which once you get out of trading into sort of, let's say, conventional business, one thing that I underestimated the importance of was the value of your word. So when you're a commodity trader, particularly physical commodities, when you are having dinner with someone and you agree to sell them a cargo or sell them a commodity, it's understood that when you say done, that is a binding agreement. And that binding agreement rests on the confidence that the buyer has in your authority to make that sale. And it also rests in the confidence that the company you work for knows that you will make a competent decision and they will back that decision as well. And that's something that I think is probably unique, strictly unique to trading, particularly physical commodities, and probably not so evident in general conventional business practice. I think in terms of the importance of putting words into numbers, which is what trading is all about. It's about taking rumours and talk and discussions and putting it into numbers in a spreadsheet, for example, to analyse the market. I think those qualities are pretty important in general business, being able to put words into numbers to be able to make what could be as subjective data converted into quantitative data or objective data and then make an objective decision. I think that helps a lot as well.
Just for the benefit of the audience that maybe haven't been a physical commodity trader, give an example of maybe the most memorable physical commodity deal that you've done in terms of where the word is your bond, either over dinner or breakfast or whatever it is, to give the context of that, because I share your observations. It's not as common outside of physical commodity trading, really, where you're negotiating with people, or even just on the other end of the phone, not on a recorded line, that you've never met before in a completely other part of the world. Mm-hmm. Your word is your bond. But for the context of the broader audience, is there anything that's sort of one deal that's sort of a good deal? Doesn't have to be a good deal that's etched in your mind.
Yeah, there's probably a couple of deals. One is the first shipment of cotton I ever sold into China. I remember the name of the company. I remember the people. I remember making the sale. That was pretty exhilarating as a young bloke, just in the business for the first time. Probably the second, I'll give you 3 examples. The second was when I bought my first lot of US cotton for the first time. And that was just over a phone, talking to a guy out of Lubbock, Texas. And that was pretty exciting, something new. And at the other end of that spectrum, there was some commodities that I physically sold to a processor, and I'll keep it as ambiguous as I can to sort of protect the guilty and the innocent. Anyway, I sold this commodity to the consumer for delivery in 6 months or whatever it was, and jumped back on the train and heading back to the capital city. And over that period of 2 or 3 days, the market came off about 5%. And anyway, I called the client. I said, right, I'm sending the contract through now. I'd like it signed and returned. And of course, crickets. So I don't know who you are. So I think the market difference at the time was not insignificant. I mean, it was a lot. I called my boss at the time and said, oh, look, this is what's happened. And as I sort of started to regale him of the situation, he said, Mark, stop. And I was in a country in the middle of nowhere. And he said, stop, don't come back until you fix it. And hung up on me. So I jumped back on the train and went back out to the upcountry area. And anyway, as it turns out, we managed to sort of stand the deal back up so we didn't lose any money. And so that was sort of my first introduction to physical commodity trading, where one should not take for granted who your counterpart is, the importance of the integrity of that handshake, if you like, or that commitment, and also around risk management as well.
And also, some of it is cultural. China's gone a long way now, but I remember at times when we started at Noble, even within the team, the concept of agreeing a price and it not being consequent, like continually up for negotiation was a bit of a foreign concept in terms of, it was always up for negotiation until the cotton arrived and they had to pay the money. And, trying to explain that, no, if we're hedging something and has to be, the number is the number. I mean, some of it, maybe they hid behind it, but to me, it also was just culturally, everything's always up for negotiation.
Yeah, I think there's a principle, that's right, but I think there's a nuance there that is, and I often or occasionally use the contrast between, say, how we do business in let's say, the democratic West, where we have a system of law, we have a system of enforcement, where you and I can meet each other for the first time and transact and know that even before we sign on the dotted line, as long as there's some sort of evidence of a transaction, that's an enforceable agreement for you and for me. And so the system by which we operate or under which we operate affords us some protection. Now, if you go to China, where you have this concept called guangxi, right, which is the concept of, once we get to know each other and we spend some time understanding each other, integrity of that agreement is underwritten by the substance of our relationship. So that, I'm not suggesting at all that, one is better than the other. I have a preference because of what I'm used to, but that's an example of how a cultural difference affects what the investment should be in terms of how you manage counterparts and govern risk.
Yeah, that's a good point. And in terms of looking at, again, trading business, it's not all glamour and Lamborghinis. In terms of aligning interests of, if you're managing a trading business, you have traders, you have non-revenue generators in operations, and there was a lot of, let's say, system design around how you incentivize the team, how you incentivize the business, which we don't need to go into a huge amount of detail. But I think in terms of, taking some of that knowledge and applying it outside of trading, one of the interesting things is people creating the right incentives for their own staff or their own team or their customers or their investors. How do you think your experience in trading, a lot of it is incentive in terms of your own pay, your boss's pay, your team's pay? How has that sort of informed either how you structure deals, how you think about building a team, those kind of things in terms of general business?
Yeah, I think that question probably deserves a bit of context to start with. And when you think about trading, it's a pursuit that is heavily weighted towards IP. That is the IP that you and the team have by virtue of experience, by virtue of relationships, by virtue of understanding the business you're in. So you come into the office in January and you have capital, you have a team, you have relationships, and you essentially are required to conjure up opportunities to generate profit out of moving goods from A to B. Now, if you're an infrastructure investor, of course you have to be competent, you have to do the numbers, you might need to make sure that it's managed well, but essentially your upside opportunity is driven by external factors, not by how good your team is in doing that. Whereas trading, your upside opportunity is purely driven by the people and nothing else. So that's why my view is that's why in trading it's weighted more to performance and less to just base salary and some sort of nominal bonus upgrade. So it's an important contextual difference to be mindful of. So when you think about trading, the qualities that you're looking for in terms of a trader is, ideally speaking, you want them to be, poor, hungry, and smart. It's a cliche, but it's so true, because you want people who are willing to get on a plane anytime, any place, hustle opportunities, make sure it's executed well, remove those inefficiencies out of the supply chain, which is the margin that the trader is trying to capture. So you need to have a certain amount of ambition. You need to have a certain the minima in terms of work ethic, and almost certainly you need to have competence and some intelligence, and you've got to be numerical. There's just no other way to do it. So my default position is I always prefer to pay people a modest base salary and weight everything towards performance remuneration. But it depends on the business, and I think Australia culturally probably aren't as developed as some other jurisdictions in that respect to that concept. I'm sure there are some well-remunerated people through bonuses in private equity or whatever it might be, but in commodity trading, it's a bit of a foreign concept in Australia compared to, say, Switzerland or the US.
No, it definitely seems to be higher. Relatively higher base salaries, much lower performance incentive. And in terms of sort of bringing it back to Australia, there's actually an interesting podcast I listened to a couple of months ago. It was generally about Australia in general, but it was also about the lack of productivity in Australia. But interestingly, one of the most productive sectors in Australia is farming. So agriculture to the farm gate, if you think about it that way. And if you think about the trading industry and the broader industry on the back of that, I'd say it's probably not the opposite, but not particularly innovative and not particularly productive. Do you have any thoughts on why that is, or do you disagree with me? But as for both former farmers, they always seem to be, you did have to innovate to stay viable, stay afloat. And that seems to be not so much once the commodities gone past outside the farm.
It's an interesting contrast. I think what Australia has done well as far as agriculture is concerned is farmers have assembled themselves well into groups that finance or part finance research, for example. So cotton, the GRDCs, grain, all the rest of it, where Australian wheat yields over the last 50 odd years are increasing at a bit over 1% a year on average. Cotton is a great story where with the introduction of GMO, the introduction of just genetics, improvement in management practices, they've seen yields basically double in 25 years. From a cultural perspective, I think Australia absolutely has it right on farming, where we invest in improving genetics, improving management. And as a side note, it depends a little bit on the enterprise type as to how much you can improve it. So if you're a dryland wheat producer, you're limited physiologically by the virtue of rain.
Yes.
Whereas if you're an irrigated cotton producer, you're not limited by water availability, but you might have other limitations. So I think there's a good story there for Australia. I think gene editing is going to be a really interesting opportunity in crops particularly, and maybe livestock at some stage, I don't know. In terms of contrasting that pre-farm gate productivity over the last 25 years with post-farm gate processing and or trading supply chain, the cost to move a product from farm gate to a consumer in Indonesia or a consumer in India has probably not changed that much over 2-3 decades. So the question there is, well, why is that? Is it not becoming more fuel efficient? Labour costs gone up? Is the supply chain just had maximum efficiency? My view is that there's probably a limitation on how much more efficient we can be in moving goods from A to B just by virtue of you've got to consume labour, you've got to consume fuel. All of your assets are amortising assets. So there's a limit, I think. In terms of other efficiencies around digitisation, I think there's probably opportunities around digitising the exchange of title and payment, which has seemed to have opportunity for a long time, but still hasn't really developed into a real thing. I suspect also that particularly commodity trading, physical commodity trading, has limitations in terms of removing the human factor. Certainly communication's got a lot more efficient, but you still need to be on the phone, you still need to be anticipating, hustling. So I think that's here to stay for a little longer.
In terms of moving to today, so Thera's how many years old now? 6?
Since 2018, so 7 odd years.
What's the story so far? Like what was the impetus for starting the business? How's as you say before, the growth is never linear. I'm sure it had its challenges, throw a pandemic in there, a bit of commodity volatility on top of that. How's that, how did it get started and what's the story so far?
Yeah. So when we came back to Australia from overseas, I think it was 2014 or 15, something like that, I sort of moved on from trading and sort of looked more broadly in agriculture. I wanted to stay in ag. So I did a bit of consulting and learned a few things. And as Providence or fortune would have it, in my travels, I ran into another guy who was in sort of private credit, hedge funds, banking, trade finance, and he and I did some business together. And then over a drink one afternoon and said, well, why don't we set something up and see how far we can take it? We don't really have, in Australia at least, we don't really have a concept of a non-bank lender in ag. You've got obviously the banks, then you've got what we would call informal lenders like an Elders or a Nutrien and even livestock agents lending money to their clients. But you don't have the equivalent of a Resimac or a Pepper, one of these guys that's sort of non-bank lending in Resi, for example. And so that was sort of the genesis of a strategic direction of let's go, in this 45-degree direction. And then over time, we've sort of narrowed the strategy down to be very, very acute and focused on what we do now, which is financing farmland, livestock, crops, and then farm equipment. The business and the business model has been pretty well tested. So when we started it at one of the worst droughts in a long time, rolled from that into the pandemic. Then we rolled from that into, I think there were some bushfires in there as well for a while. And then interest rates went from 0 to 5% in a couple of months. Then we also saw livestock prices go from a historical high back to below the mean. And that was a difficult period for particularly the livestock industry because a lot of farmers lost more than they could afford to really. And that really tested our model as well, where we had to restructure clients and sort of carry them through. And that sort of thing is not comfortable for anyone. It's difficult for our customer, it's difficult for us. But the model was tested. Sort of, I think we're pretty happy that it works. And of course, through that whole period, you're trying to raise capital, you're trying to deploy capital, you're trying to develop products or narrow your focus. So far, we've been tested, we've survived, and I would assert flourished. We've got a very clear direction. Now it's just a question of really focusing on deploying and tapping into sort of deep pools of capital.
What's the biggest challenge in the business? Is it raising capital or deploying capital?
It's a bit of a seesaw. So in the life of an asset manager of any description, I suggest, is the first challenge is raising capital, and then the second challenge is deploying capital. And the key is to try and keep it balanced as best you can. So I'd say for us at the moment, our challenge is more about originating deals. So our capital sources are essentially the securitization market. So Australia has, I'm told, the second largest securitization market in the world. So it's sophisticated and very deep pools of capital. And then we also have some fund management businesses that run parallel as well, so fee-for-service type thing. So once you sort of have the availability of a securitization market, that essentially all things being equal, solves for your capital availability problem.
Okay.
Assuming you do what you tell them you're going to do, and the markets don't seize up.
Yes.
So originating is a bit different. So my view is that one of the reasons the major banks particularly have been closing branch offices in the bush, moving clients to a call centre solution rather than sort of having direct relationships is because cost to originate, cost to serve in agriculture is high. Culturally, business in agriculture really revolves around the personal relationship. So we like to get on the farm, we drink the tea, we eat the scones, drive around the farm, which is good for business, the business relationship, but it's also good for credit risk management. Customer is, who your customer is, where your collateral is. So once you sort of develop that origination network, which can either be through brokers or it can be through your own relationship managers or it can come through intermediaries like accountants, referrers, then you start to solve for that origination problem. Where we're at the moment, we're about sort of 60% through the broker channel and about 40% through our own network of relationship managers. I'm not sure where that's going to settle out in another couple of years. There's definitely appetite for farmers to have a direct relationship because they like to be able to pick up the phone and get an answer straight away. But also brokers are seemingly, they're here to stay as part of the market structure.
And in terms of you said the aperture was wide and then kind of narrowed. Are there any things that you would steer clear of in terms of financing in Australia, or is it in the agriculture sector?
The short answer is no. The more nuanced answer is because we represent ourselves as being agriculture focused, we can't very well pick and choose. So if an applicant comes to us and says, I want to borrow $1 million for this reason, we can't just say, no, we're not funding that part of the sector anymore. We've got to be able to give them a response that all things being equal is, yes, we can do it subject to these parameters, and the parameters might be a little tighter than what they might, would have been in better times. But, it's a bit of a cliche, but red wine grapes is obviously a little bit on the nose at the moment for banks, whereas we fund that stuff and we sort of tighten up the parameters a bit to protect ourselves. We don't do things like oysters or seafood at the moment, not to say we wouldn't look at it in the future, but most of our portfolio, or our portfolio generally looks like the Australian ag sector, so call it roughly 2/3 livestock, 1/3 of crops of different descriptions. That's sort of, and then sort of spread out geographically where that production is. That's more or less what our portfolio looks like.
And are there any areas you want to get into that you're not already into, either geographically or sector-wise?
We want to be able to walk onto a farm, and if the farmer says, I need a debt solution for this problem, we want to be able to give them a solution for it. So that was sort of the genesis of having the three products, the farmland, seasonal, and the equipment. There could be opportunities around financing people that finance farmers, livestock agents, for example, retailers. So we're looking at that as an opportunity, and we think that could be a tool to widen out our portfolio size and diversification. I think there's other opportunities in ag by virtue of where we operate. So we have grower relationships, we understand ag risk. So there's probably other things that we might over time add on to our business mix, whether that's sort of around providing other services, whether it's around products that are sort of could resemble some sort of crop protection, something like that. So we're open to opportunities that can help us grow without diluting our attention, our focus, or certainly profitability.
The weather derivative market here has got a bit more liquid, I think. I don't know if that helps with crop protection. I assume there's some correlation, but apparently it's a lot better than it used to be, certainly when I first looked at it 20 plus years.
Yeah, I think there's been a few swings and misses in crop insurance. We've got some early thinking about a solution there that could be pretty novel and provide a much more fulsome cover for a farmer, which I think would be well adopted by the banks and the retail input providers. But like all things insurance or insurance-like, you've got to have scale and diversification. So I think in Australia, or maybe not just Australia, but probably farmers generally are not going to buy 3 years or pay for 3 years of insurance so that the insurer can get diversification over 3 cycles. Yeah. It's going to come out horizontally where you've got to be able to insure the whole country, east to west, north to south, to get your diversification.
Yeah, so for the benefit of listeners in Australia, there's no real... You can get frost insurance, maybe?
It's pretty common to get like end of season insurance for something like hail or fire. In the US, where you can get crop insurance subsidised by the government, that just doesn't exist here. And probably also, for context, Australian wheat yields and dryland wheat yields they move about 30% higher and lower than the mean historically, whereas in North America it's closer to 10%. So by virtue of our climate and our seasonal variability, you get that production volatility.
That's a challenge. It always has surprised me that something hasn't been able to be launched, but when you sort of think about the challenges, then there's no surprises. All right. I don't think I have any more questions.
Well, we're done.
I think we're done. So that's a wrap. Thank you, Mark, for your time.
Thank you for hosting me. And as always, thanks for your time and good luck with it all. And see you.
All right. Thank you. That's a wrap.
Well done.
I hope you enjoyed this episode of the GSX podcast. You can find out more about GSX at greatsouthernx.com and follow us on X at GSX Commodities. You can also follow me, Henry Walsh, at H2Walsh. Until next time.